All right. Yes, perfect. So first of all, let's recap quickly what we went over. The first video started off, of course, with PD arrays. They are the basis of everything. It starts with PD arrays. They create the foundational levels. Then we went over fair value gaps, why they are so important. They are the superior PD array, you could call it. Then that superior PD array, the fair value gaps, lead to order flow. That order flow basically tells us everything, where the market wants to go towards, where is it coming from, everything. But we need to understand it's relative, as in it's relative to every time frame that we are looking at. So that is very important. Then that order flow, what we briefly touched on at the end of the video, is that creates context. That order flow creates context, and that is exactly what we are going to go over today. So we are zooming in more and more and more. We first off start with an eagle eyes view, so a big overview of the market, and now we're zooming in more and more and more. And that leads us to having context as well. So what exactly is context? What are the different types of context as well? And how can we use it in our trading? That is very important. So the first thing that we need to understand is, again, order flow leads to context. So yes, there is context, but first, there's a reason why we made the first 3 videos first, because that leads to our context eventually. So you are always looking to trade context, whether it's an unusual context or the usual context. That's the 2 types that we're going to go over. You're always trading in context. So for example, if I ask you, what's the context of this trade? Then you always have some type of context. There's always a context that you can show me. If there's no context, then likely it's not a good trade. So you are always trading context, and that means that it's always a protected high and, well, or a protected low. Because if you're bullish, of course, you're looking to target an unprotected high. If you are bearish, you're looking to target an unprotected low. And of course, if you're bullish, you have a protected low that you're trading off of. And if you're bearish, you have a protected high that you're trading off of. Now, what does that mean? Again, all things that we're going to go over. The target is a previous X high or a previous X low, and or a swing high / low. Those are your usual targets. In targets beyond the context high / low, we can target other PD arrays. So what does that all mean? What we're going to go over right now. So again, we established here on GJ, on GBP JPY, that we had bullish bias. So direction was overall bullish. With the direction being bullish, we target premium arrays. So at this moment in time, right there, we have one premium array that we can target, which is this high, potentially further to the left, but a target, that's something we're going to go over in a different video as well. Then the next step is narrative. All right, so if we can target a previous week high right there, how can we actually look to target it? Well, right here, we have this fair value gap. So if we are going higher, then we are going higher likely off of this weekly fair value gap that is sitting right there. All right, that is interesting. This creates overall our order flow because order flow was bullish, etc. Then that narrative goes hand in hand with the third step of the foundation levels, which is a boundary. A boundary means that it's a boundary to perform the next step. So in an algorithm, in a mechanical step-by-step guide, there is one step that leads to the next step. So a boundary right there is something that is the border. You could see it's the next that leads to the next step. If that boundary is fulfilled, so it's valid, then you can perform the next step. The boundary at the third step of the foundational levels at the top right means that it's the boundary to now go into the lower time frame to look for a potential entry pattern. That is what we mean with the boundary. That is the first step of the context. So that creates the PD rate that you want to trade off of in your context. Then the next step is the fourth step, and that is the target. So that is the target of your context. Both 3 and 4 together create context. they create context. That is why we have in brackets context right there. So before you get to the entry pattern, you know which PD array you want to look for where you want to look for your entry pattern, and you already know what you want to target as well, what your ultimate target is. So right here we have established we might go higher off of this weekly Verwijkup right there, off of that discount array, because overall we're bullish. So we're looking for bullish context. All right, so we're having bullish context right there potentially. Well, perfect. If we come into that weekly Verwijkup right there, then the target is that previous week high, because that is what we touched on in the previous video at the end. With order flow and with context, we are moving from PD array to PD array. So from the discount array that we are coming into in a bullish context, the first premium array that we encounter, which is usually going to be 9 out of 10 times, that's going to be, and 9 out of 10 times, I also want that for you to be a previous X high, previous X low, or a swing high / swing low. That is your context target. Then later on, we'll also look to incorporate potentially fair value gaps, all the good stuff, all the other PD arrays. But your context high, and why is that a context high? Because right here, your context high is the target, because you have bullish context. So the context high is the target. So the context high right there is the first premium array that we encounter, which is the previous week high right there. In a bearish context, so if we have bearish context, then the context low can again be a swing low, can be a previous X low, whatever it is at that current moment. So this, from this area, from that discount array that is sitting right there to that premium array, that first premium array, that area creates context. That is your context. So the move from the PD array to the PD array, that creates your context. Again, that context can't be established if you don't understand the first 3 videos right there. Because moving from PD array to PD array doesn't mean that we're constantly bouncing in between PD arrays to PD arrays, etc. And that's not how it works. There's first a few steps that we went over right there to create this context, which is very important, right? So if we understand that, then the next step here is what I want to briefly touch on as well, but it's not that important, is a market maker model. Because this area right there is where your market maker model forms. So this is you now understanding where a market maker model forms. And you didn't need, and I didn't need to label it as a market maker model, because it's not relevant to label it as a market maker model, which is very important to understand as well. So the next thing I want you to understand is, again, the house rules that we went over, right? We don't now need to go to a different mentor and understand, all right, what is a market maker model, blah, blah, blah. No. We already understand what it is, and I'm trying to teach you it right here. We just don't need to label it as a market maker model. That is very important to understand right here as well. So right here, this is where every PD array on the lower time frame that you're seeing will hold when they are in context. So that context is extremely important, because that is the area where we are going to be trading. That is our context area. You're always going to trade a context. Whether it's a usual or an unusual context, you're always looking to trade context. So again, what is context? What is usual context? Usual context is when you are just looking for order flow to follow through. That is usual context. So right here, if we look at this, we are just looking at order flow to follow through, right? So this creates usual context, just a normal context, just very textbook context right here, which then again, you would go into the 1 hour time frame, and then that is the entry pattern. That's the next step. That's not something we're going to go over right now, but basically the same thing you're doing on the weekly right here. You're creating the same context on the 1 hour time frame, for example, how you combine the time frames to find the right entry pattern, etc. All things we're going to go over later on. Don't worry. But we first need to understand context here. And this right here is context right there. That creates our context, our usual context, because we're just looking for order flow to follow through. Then we also have the unusual context, because unusual context is what we briefly went over as well in the previous video, is where order flow is not following through. That creates unusual context. Now, here I want to go over a few more examples as well, and you can, of course, figure out with me if it's usual or unusual context. Now, of course, I already have an idea, but you can try your best to see if it's unusual or usual context right here. So here we are on GBP Canadian dollar, and I just want to show a few examples right here. That if we're looking for order flow to follow through, then we have this daily order flow that swing low. We have this daily fair value gap that is sitting right there. And we have potentially that order block right there. Now, again, very easy bias overall. Just looking at this order flow lag was bullish. Narrative, if we are going higher, where are we going higher from? We have this daily fair value gap sitting right there. Perfect. That creates our boundary as well. So the narrative and the boundary, they go hand in hand. What is then the target? The target is then this high, right? That is the target, because that is the first premium array that we will encounter. Again, when I speak about boundary and target, they are on the same time frame. So it's not that you would use a boundary on the daily time frame and you go into the 1 hour time frame to look for a target. No, it's not how it works. Boundary and target are on the same exact time frame, always. So right here, what you want to do is you want to go into the lower time frame right there to look for high prices. But what can we also see? That if we zoom in on this candle right here, and I move this to the left a little bit, then we can see the first down candle, which is Wednesday the 22nd of November right there, if you want to follow along with me, as GBP Canadian dollar. Then right here, this is coming into the daily value gap pretty heavy, pretty low as well. So right there, it might have not even given a confirmation just yet. All right, how can we know that it now wants to create a new boundary? Because this boundary is not off of the daily fair value gap anymore, or off of the order block. Because if we pay attention right here, and we pay very close attention to the details, then we see this previous day low right there, that is now becoming our boundary. So the previous day low is again just simply the low of that down candle right there. Oh, that creates our boundary to now go into our entry pattern time frame to look for our actual entry pattern. So that previous day low at that moment in time was our boundary to now go into the lower time frame to look for that target, to target the target. So it was this previous day low towards that high, which was our context right there, not the daily fair value gap anymore. Because the daily fair value gap, we already came into it. The order block, we already came into it the first day right there. And we didn't expand higher off of that. So then the previous day low becomes the boundary to trade off of. Because we always need a clear and a clean and a crispy discount array to look for a trade off of. So when a daily fair value gap has already been used, or an order block has already been traded into, has already been used up, then that can't act as a boundary anymore. Because we also need to understand, a boundary is a one-time thing. So if you're looking, for example, at a 15-minute entry pattern, then if the boundary is already gone and you're just looking at a 15-minute entry pattern, then the whole trade ID, the whole trading plan is not relevant anymore, right? Because then we could very well just go over the 15-minute time frame and look at entry patterns everywhere. No, there needs to be a boundary first. And that boundary is the PD raise that we talk about. Once the PD raise has already been traded into, that can't act as a boundary anymore. So a boundary is a one-time thing. And then you either get the entry pattern or you don't, and then you start all over again. Then you start with the bias, narrative, boundary, target, entry pattern. Don't get the entry pattern, you start back all over again. Again, all things we're going to touch on way, way more. I just wanted to show you that the previous X low can also act as a boundary. Not only as a target, can also act as a boundary itself. And it's the same for a swing high. Can also act as a boundary. Doesn't always need to be just the target. Can also act as the boundary. Now, how can you know that we are going to sweep that previous X low right there? How can you know that we didn't want to expand higher of the Verweij gap, of the daily Verweij gap, of the daily order block right there, higher just yet on that day? And how do we know that previous X low was going to happen? That is things that we are going to go over with time as well, and with candle signs. So that is coming in the next few videos. I just need you to understand currently that is also context. So that also creates context and that boundary. That, it's very important to understand. We had 3 discount arrays here. The fair value gap, the order block, and the previous X low, the previous day low right there. So the boundary that was responsible for pushing price higher was the previous day low, was not the daily order block, was not the daily Verweij gap. Yes, they play a part for pushing price higher because they're part of our current order flow, but they are not the boundary for us to look at the entry pattern. That is important. That's what I'm trying to ingrain into your mind right here. Because if you're using the daily order block is quite big. So we need to get very accurate with our way of where we want to see higher prices from. Because the order block could have come into the open, could have come into there, could have come into it a little bit lower there, lower there, lower there, could have swept a low. So what is the boundary for us to go into the entry pattern to look for our entry pattern? That is very important, because if we use the whole daily Verweij gap, if we use the whole daily order block, then we have so much boundaries that we can justify a trade ID always. You don't want to be able to always justify a trade ID. You don't want to be trading every day. You want to have very great accuracy. That is our goal. So that is again when the previous day low right there is the boundary. Can also be a previous week low, for example. Whatever the context is right there. That's very important, and that's what we're going to dive into more as well. So that creates as well, this is what you can be called a usual context still. I would still call this a usual context. It's a little bit of a variation to the usual context, but this is still a usual context overall. Then we are going to move into the unusual context. And this is where I'm going to use a little bit more examples, because I think it's a little bit harder to understand as well. And the unusual context is where we have disrespect context. Now, what does that look like? First, I need to take you through the whole idea right here, where at this moment in time, we had Canadian dollar CHF. And currently we are having, of course, just bearish order flow, but we are also potentially sweeping this low right there. And we're getting a very aggressive move higher right there. So it's like, all right, are we respecting this bearish order flow, or are we ready to create bullish order flow? At that moment in time, we could say, all right, we have just bearish order flow creating what? Creating bearish context overall. Now, if we ignore that and just look at the right side, so we are not trading off the premium array to the left side right there, then here we can see once price comes into this level right there, then that prevents a bullish monthly Verweij gap to be created. That prevention of the bullish Verweij gap being created also prevents a potential order flow lag to be created right there, which is then overall, again, a new boundary. That's a new boundary to look at potentially the weekly time frame to find your usual context. So the way unusual context works, it's a disrespect boundary. What does disrespect mean, etc.? All things that we're going to go over as well in a later video. It's a disrespect boundary that can allow you to go into the time frames below it to then look at a usual context. So right here, the lack of creation of that monthly Verweij gap higher allows us to now use that boundary to go into the weekly time frame to now look for our usual context. So the way you would approach that is, again, this is something we're going to go way more in depth on as well, on how you can know which high is protected, etc. But this is a general rule of thumb, where if we create that boundary, that disrespect on one time frame, you go one time frame below it. So monthly to the weekly. If it was on the weekly, you go into the daily. So the weekly here, you go into this and you just use your usual context, which is this right here. weekly fair value gap to that weekly low. To eventually, of course, what was the target on the monthly? This low right there. And that creates your weekly context, your usual context again. Which on the same thing that we can see right here is that if we make this very fractal, we can see that we have a move higher. And if you ignore this premium rate, then you can see that this candle, that bullish candle, if it was to be bullish, the weekly time frame, what should it have done? It should have created what? It should have created a bullish fair value gap. What is the lack of a creation of a bullish fair value gap? How can we know it's a lack of a creation? Well, we can know that there's not a fair value gap being created by simply understanding the 3 candle pattern that creates a fair value gap. 1, 2, the 3 should be higher, then should close higher than this right there. The wick should not come back towards this high of that first candle. All right, so if we know that, and this happens, hey, that is again now a boundary to do what? A boundary to potentially go into the daily time frame to look for daily fair value gaps lower, to look for that daily fair value gap right there, or potentially an entry that creates again that boundary to then that target right there. And that is in that area again is where you want to have your entries, because that area is where your market maker model happens. So it's very crucial to understand that you're always trading in context. Once that context is gone, which is once the target has been reached, you need to be extremely careful with whatever you're doing. You don't want to take a trade immediately straight away anymore. You always want context. And the context ideally is on the time frames that are above you. So ideally on a monthly, if not on the monthly, ideally on the weekly, if not on the weekly, ideally on the daily, if not on the daily, ideally on the 4 hour, and so on. And the reason for that is because if it's on the daily or if it's on the monthly, then that creates the highest probability, because that is the strongest fair value gap. That's the strongest PD raise to take a trade off of. That will disrespect everything that's on the weekly. And the weekly is stronger than the daily. So ideally the weekly. The daily is stronger than the 4 hour. So ideally the daily. The 4 hour is stronger than the 1 hour. So ideally the 4 hour. If that makes sense. Hopefully that makes a lot of sense. And if we go over the steps right here, then overall, what have we just done? If we look at the monthly. Monthly overall was bearish. Just a bearish order flow, bearish context. We did sweep this low. So we needed an extra confirmation. Let's call it that way. Then at that moment, once we traded into this potential fair value gap, that first candle high right there, that created a bias, because the lack of creation of that new fair value gap higher created our bias that indeed we do want to continue lower. It showed intention that we still wanted to continue lower, which is then, all right, if we are continuing lower, the bias is bearish, then what is the target that it can reach for? Well, what is the discount array that is sitting right there? The discount array is this low right there. Then the next step is the narrative. All right, well, if we want to continue lower here on the monthly, where are we continuing lower from? Well, we just had this boundary, as in we just had the lack of creation of that order flow higher, of that fair value gap higher. Well, we can wait 3 months until we have potentially a month fair value gap, but that will not allow us to capitalize on this move, where the draw on liquidity is quite clear in the form of this low. So ideally, I want to already capitalize on it, which means that at this moment, since we don't have usual context, it can allow you to perform an extra step to go into the time frame below it right there, to go into the weekly, to find your premium array, to now capitalize on the trade. Why into the weekly? Why not into the daily? Well, we also had a daily fair value gap in the form of this daily fair value gap. Why did this daily fair value gap at that moment in time not follow through and not create a new daily fair value gap lower? That is because we are creating a weekly fair value gap right there. So this is the whole weekly fair value gap at that moment in time. So that is again combining the time frames. What are we seeing? What is important? We need to understand we are also creating a weekly fair value gap. Then the next step right here is this weekly fair value gap then creates the narrative. Because if we are going lower, we now know where we are going lower from. The narrative. And that also creates the boundary. That boundary again creates the PD rate that we want to trade off of. So here, if we are going lower, where are we going lower from? We want to look at a premium array. That premium array is the boundary. What is the first target that we encounter? It's this low right there in context of the weekly. So that is the first target that we encounter. Then the next target is, of course, the monthly context that we had, because we had unusual context. Then the next thing is, if we go into the daily, and off that weekly right there, the bias was overall bearish, so direction was bearish. We want to target discount rates. Then right here, the narrative is, if we are going lower, where are we likely going lower from? We have this daily Verwijk gap sitting right there. That creates this target context right there. So we have context right there. If you were to go into the lower time frame, you would want to get involved in between this premium rate and that discount rate right there. All right, so that creates context within context within context. This is extremely high probability. And all that rests us to do right there is find an entry pattern and apply our risk management. Now, again, that is things that I want to go over later on. I just want you to fully understand and fully be capable to see every type of context that I select right here. So if this is a little bit overwhelming, then again, that's perfectly fine. Watch it a couple of times. It will make a lot of sense if you watch it a couple of times, do case studies, and find that unusual context and find that usual context in accordance with the videos that we've just gone over as well. So let's move on to the next example, which is going to be about ES, about the indices, because of course, it's all the same. It's all the same. We apply this on every single market. It's all the same right here. So at this moment in time, we had this daily Verwijk gap sitting right there. So we had this daily Verwijk gap, and then we also had a very easy target. So all I did right here was mark the closest discount array, and mark the closest premium array right there. Didn't take into account the previous day low, a little bit for further target as well, which you'll see the previous day low, previous day high comes in very handy later on. But right here, all right, we might want to continue higher off of this daily discount rate, because that's the one in context right now, right? If we are continuing higher, where are we likely continuing higher from? Well, we have the daily Verwijk gap right there. So that daily discount rate can be responsible to create that boundary, to then create the target, the entry pattern, whatever it is. All right, but what is the next step? Can we potentially look to trade towards the daily fair value gap? Because like I mentioned in the Verwijk gap video as well, the fair value gap on the higher time frame on a weekly, monthly, daily are not just fair value gaps to trade off of. They are also potentially fair value gaps to trade towards. Now, there's very specific conditions that later on in this mentorship we need to go over to fully understand that, to fully know what you are doing in regards to that. But right here, if we were to trade towards it, how could you do that? What could that look like? If we go into the 4 hour first, then the 4 hour we can see, all right, we are trying to push higher right here, but we are just not really doing so. We had previous order flow, which is sitting right there, which is already lower probability. And the reason it's already lower probability is because we just simply have this daily Verwijk gap below it. So it's already lower probability. Then we are not creating a new daily Verwijk gap higher off of that. All right, so there's two things right there that are very suspicious. Daily Verwijk gap below, so daily order flow below 4 hour order flow, which means that the 4 hour right there is not in context of the daily time frame, which means it makes the 4 hour right there, trading the 4 hour, lower probability. All right, but it doesn't mean that we can just take a short right now and target the daily Verwijk gap. No, because it still might deliver higher. So what do we need? We need unusual context right here, because the 4 hour creating a bearish Verwijk gap. Yes, you could of course look at that, but we might already deliver into the daily Verwijk gap right there before we even get the 4 hour Verwijk gap lower right there. So right now, without having that new bullish Verwijk gap higher on the 4 hour, that creates now a context. That creates an unusual context, a boundary to look at the 1 hour time frame right here, which we can also see is not creating bullish Verwijk gaps, to go into the 15-minute time frame to find our boundary right here, to look for a trade ID. right there off of that fair value gap. This order block did not create a fair value gap lower, so it's personally not something I would use. And then we create this right there, fair value gaps lower, and we deliver towards the daily fair value gap. So this right there, and potentially in between that as well, maybe on the 5 minute, even lower time frame, that could have been boundaries to then do what? To look for that entry pattern, to get involved on this move lower right there. So that is how you trade towards a daily fair value gap potentially. So that is very interesting, and that again creates an unusual context by reading the fair value gaps right there. Because the fair value gaps were telling us right here, all right, we do not want to continue higher currently. So we are seeking a lower discount array to then potentially continue higher off of that. So that is why we had the daily fair value gap right there. So the daily fair value gap is sort of acting as a magnet. You have this premium array in the form of that swing high as a magnet, and the daily fair value gap as a magnet. Then the lower time frame, so the 1 hour, the 4 hour, the 15 minute, 5 minute, you are using those fair value gaps in context of one another to see where are those fair value gaps guiding us towards. The fair value gaps here initially were guiding us towards that premium array. But then eventually we did not create new fair value gaps. So they were guiding us, they were telling us, all right, we are not creating new fair value gaps higher. So that tells us that overall we don't have the intention higher. So that means we have intention lower. And that is when we can trade towards it right there using that unusual context again. So then the next step is we are coming into this daily fair value gap. Now, this is again where I would expect a previous day low sweep to then continue higher off of that. Why a previous day low sweep to then continue higher off of that? Why did that previous day low sweep higher and then we continue higher? Well, because at that moment in time, we need to understand on this day, on the first day that we come into the daily fair value gap, now the boundary is to go into the 15-minute time frame, into your entry pattern time frame, to look at that boundary, which is the daily fair value gap, to look at this target right there, potentially, and potentially that target. All right, so then you use the entry pattern time frame to use this as a boundary to look for your entry pattern, to get involved, to target higher. But at that moment in time, if we do not do that and we create a new discount array sitting right there, the previous day low, that is now the new boundary. And the reason for that is because we come into that daily fair value gap late during the day right there, which is all things we are going to go over in time. So you can see I am getting a little bit potentially ahead of ourselves here. I'm getting quite advanced currently. And if you do not fully understand this, perfectly fine, as long as you understand where context can happen, what is context, all that currently. So this, again, what created the context right here was the previous day low right there towards the previous day high, not the daily fair value gap. It was the previous day low towards the previous day high right there. That created the context. And then eventually we delivered higher. So that is how you use trading towards the daily fair value gap, but also trading off of it. So the magnet and the bounce pad where we continue higher from right there as well. So that is how you utilize the usual context that we had right there and the unusual context as well. And this comes in very handy later on. Will make a lot of sense later on as well. So right here, I want to go to the next example, which is crude oil. So let's take a look. We have another context right here. And again, you can use this, and I'm not going to mention it initially. So just try to see what context this is and how I go over the context. So I'm first going to mark it out, then try to creep into my mind. And it might be very difficult at first, right? Don't worry if it's difficult. It's completely normal. But it might be very difficult at first to creep into my mind to say, all right, what would Arjo say here? What are we doing here? And then afterwards, I'm going to go over it in depth and tell you, all right, I was doing this, then this created that, blah, blah, blah. Just purely focused on order flow, fair value gaps, and context. So right here, if we look at the weekly time frame, again, we have this weekly fair value gap. And from now on, I'm not going to say anything anymore. I'm just going to use the replay tool. All right, the weekly fair value gap right there. did something. What did it do? Then, which was, so what is this? What is this? All right. Interesting, right? So what can we do? What did that do? All right. Interesting. So what can we do again? What does this create? Aha. Okay. And what happened there? Aha. Okay. So hopefully you had a chance right there to sort of see what I was doing, to be able to spot, sort of get an idea of what I was doing, and hopefully creep into my mind. So the goal is right there that eventually you can look at my charts and you can see exactly why I'm doing this, what I'm doing right there, fully creep into my mind to understand what I'm doing, what I'm seeing, without me having to mention anything. Now, at first, again, that might be very difficult. So if you do not fully understand that currently, perfectly fine. I do not expect you to fully understand it currently. So don't worry at all. You don't need to understand it fully. But what did I just do? So let's start over right there. At this moment in time, I was looking at the weekly first. And the weekly, I marked out this fair value gap, because if we want to continue higher, then this weekly fair value gap can be responsible to push price higher right there. All right, that's quite interesting. And I already know, and this is going a little bit more in depth on order flow, on the flood and the lot concept, that we also have this fair value gap, the weekly fair value gap right there. So we have two fair value gaps sitting right there. I know that this fair value gap, based on the flood and the lot and the odd, is one discount array. This is also one discount array. This right here, this high, is this high? Yes, that high overlapping with this fair value gap, and then marking out that exactly. This spot is two discount arrays. So if price does not want to continue higher off of the first discount array right there, then it won't continue higher off of this fair value gap. Why not? Because it's the same. It's both one. So if price is not willing to move off of one discount array, it will seek the overlapping part. It will seek the overlapping discount arrays to potentially continue higher off of that. And if it doesn't do that, then likely the whole idea is invalidated and we are continuing lower. So that is where this daily fair value gap is the weekly fair value gap is not something you want to be trading off of. The same for the very small area right there. That's extremely small area. It's also not something you want to be trading off of, because that is also 1. 1, 1, 1. So either it's the first one or we're going to the 2 level with the 2 discount arrays. So that is how I would view that. Now, that is not something you could have known right now, but the important part is, again, understanding that context and why we see this move lower as well. So here we had this weekly fair value gap right there. So that is why I marked out that weekly fair value gap and not the lower weekly fair value gap right there. So this weekly fair value gap in itself is what? All right, that is a discount rate that can push price higher towards the new context high, which is sitting right there, which is the target. All right, bias, narrative, boundary, target, all done right there. So once we have reached that target, I can already tell on a weekly time frame that what are we doing right there? We are not creating a new expansion phase off of this previous order flow leg. So this can potentially create a swing low right there, which would mean that that creates as well a new potential order flow leg if it wants to continue higher, showing that intention. So this, if in order to create that fair value gap, it should have expanded with the body and closed above this high at least right there, because that creates the fair value gap higher, which then creates potentially a fair value gap higher on the third candle right there that could be created, which did not happen. So at this moment in time, I knew, all right, we swept that previous week high. which is now, what is now the target? This low right there, because the intention is not bullish, so it's bearish right there. Perfect. So then what do we see overall? On the daily time frame, we have a daily fair value gap right there. All right, well, if we can push price higher, we can push price higher off of that. What are we doing right there? We are disrespecting that daily fair value gap. And we're having an ST right there lower. Again, disrespecting that ST, all things that we are going to go deeper into as well. So this is something you might be very vague and you might have not understood at that moment in time. But then this unusual context, what happened on the weekly time frame, created the 4-hour usual context, where we just had this 4-hour order flow going lower right there. So the unusual context created the usual context again right there to continue lower off of that. And that is where we reached the target right there, which eventually the whole unusual context, and why I mentioned the overlapping part right there, is because then this whole unusual context allows you to go into the daily, to use the 4-hour right there to target this high within order flow going lower. And that is all constantly the unusual context, usual context. What do we have? Do we have unusual or usual context? Now, usual context at first is going to be easier to spot. Most likely, to 9 out of 10 people, it's going to be easier to spot. Unusual context requires also understanding fair value gaps a little bit more. So paying attention to details. But again, it's a full logical story. So if we dive into that logical story one last time right here with an actual live example right here. So this example, what I need you to understand is I assume that you have the basic understanding. So the very basic understanding of what I mean with unusual context and usual context. Do I assume that you fully understand it and you're the most advanced and you can go out there right now and have the boundary target? No, no, no. I don't expect that. But I understand, or I assume again, that you have the very basic understanding of context right here. So now I'm going to go into a live example, which is going to be very advanced. So if you do not understand certain things, then that's perfectly fine, because we might not even have touched on it just yet. But if you can understand just why I'm doing this, what I'm reading throughout context, what I'm reading with order flow, that is all that you need. That is all that you currently need to understand. So let's dive into NASDAQ right now with a live example. So on NASDAQ, we are seeing a very interesting thing where on the weekly time frame, we have this weekly fair value gap. And this is how I would approach it currently in a lifetime as well. Where overall, we need to understand with this weekly fair value gap, we have a couple of targets. Previous week high right there. But we also have the ultimate target, which is that. Why is that? Because if we zoom out one time frame above it, we have monthly context. So the monthly context right here created this order block right there to that high. So that is again that boundary to that target. Bias, narrative, boundary, target. And we continue higher right there with this as our target right now. So then we go into the weekly. Weekly, we are leaving behind this weekly fair value gap that is sitting right there. All right, so if we want to continue higher, we can continue higher off of that right there, potentially, right? Now, this is where I also mentioned, if once I did this on ES a little bit earlier in this video, and I mentioned that trading towards a weekly fair value gap, trading towards a daily fair value gap is always going to be lower probability, or at least I mentioned that you need to understand the full details in order to be able to fully, confidently trade towards a weekly fair value gap, trade towards a daily fair value gap, whatever fair value gap it is. And the reason for that is because trading towards a higher time frame fair value gap is always going to be lower probability than trading off of it. So the best option here is to wait to come into it right there to then continue higher. That's the highest probability. Then you're likely not going to take any losses in between. So in between moving from either lower right there to then continue higher, that lower move, you might take a loss or two before you get the higher move right there. So why is that? Because overall, we need to understand that we are bullish. we are just simply bullish. Understanding that all the longs right there are the highest probability orders. So here, only taking longs are way higher probability than taking short, because we might just do something like this week. Continue higher already without coming into the weekly fair value gap. So if you look to trade towards the weekly fair value gap right there, instead of only trading off of it, then just understand why you might take that loss. Because overall, we're just simply bullish. So all the high probability orders are long orders. So that is very important to understand, that it doesn't necessarily need to come into that discount rate right there to first come into this target, because that is the primary goal, that target. This is not necessarily the target, that weekly fair value gap. This is the target. So it might just do something like this. So hopefully that is very clear right here. That is why it's very important to understand which probability, high probability, low probability, which is also something we're going to go way deeper in on. But if we get signs that we might want to trade into the weekly fair value gap, then again, that is the lower probability trade. It is lower probability, but it can potentially, with lower risk, be traded right there. So on the daily time frame, what are we seeing? Well, on the daily time frame, we had the daily fair value gap that is sitting right there. So let me remove the weekly fair value gap a little bit to the right there. Then the daily fair value gap here created a swing low, but did not create a new order flow leg higher off of that. All right, interesting. So that means that we might want to come into the weekly fair value gap right there. So that confirms sort of the idea that is an extra confluence right there, an extra argument that we can add to the overall argument that we might want to come into the weekly fair value gap first to then continue higher. Again, what goes through my mind at that moment in time is that yes, that could be true, but overall, I need to keep in mind that overall we're bullish. So this just might take off if we get the right signs before we come into the weekly fair value gap overall. So the reason why that is important, because if you are looking for only shorts right there and you have the expectation, you set the expectation in your mind, we need to come into that weekly fair value gap to then continue higher, then that is going to be so extremely detrimental. You have just crossed the boundary of not having that open mind anymore in the market, which means that your expectation needs to happen, which means you're going to force the ID. You're only going to look at shorts. You're going to be completely ignoring the longs right there, which can only lead to losses eventually and can only lead to blowing an account. And that's not what we want to do, right? So right here, we can potentially look to trade into that weekly fair value gap now. All right, based on order flow, on the daily order flow that we're seeing as well. So let's go into the 4 hour. Let's see if we can find a boundary to continue lower potentially. On the 4 hour, we can see right here. All right, we did sweep this high right there. That's quite nice. So overall, we swept that high, but we did not create a new nice daily 4 hour fair value gap lower off of that. So right here, it comes to reading the fair value gaps very, very carefully. We had the weekly fair value gap that we can potentially look to target right here, but we have this bearish 4 hour fair value gap, which we did not respect. We had a new bullish 4 hour fair value gap right there. So currently on the 4 hour, there's nothing super clear at this moment in time. The 4 hour fair value gap that is being created right there is basically a little bit out of thin air. Would not really want to trade off it. It's not really clear where it's coming from. Then I would prefer, again, the weekly fair value gap right there for my longs overall. So the bearish as well is understanding that we are overall bullish right there. So that is also not super high probability. So at this moment in time, we don't really have the clear signs. Then if we go into the 1 hour time frame, on the 1 hour time frame right here, we can see that we had this order flow being created. Then we swept this low right there. This low being swept is quite interesting. We did not have a new order flow leg higher off of this previous order flow leg right there. So this low being swept is not that crazy. Now it gets interesting, because now it's either one of two things. Either we are going to create a higher fair value gap on the 1 hour, which will likely be used to then target the new highs overall. Or what are we going to do as well? we are not going to create a new fair value gap higher off of this sweep right there, meaning we're not following through on that order flow, meaning that we are potentially going to have the unusual context right there to then continue lower on the 15-minute time frame potentially, or on the 1 hour, depending on whichever creates the fair value gap lower. So if we get that unusual context here, and we get that bearish intention, failing to create bullish fair value gaps right there, then on the 15-minute, you might create usual context right there to continue lower towards the weekly fair value gap potentially. And that again depends on reading the fair value gaps right there. So whatever happens right there, this is a great case study to make. I don't want you to live trade this or anything. I just want you to see the case study right here that can be made. And whatever happens is going to be done. So successfully, whatever happens is going to be done by reading the fair value gaps, by reading that context, by reading that order flow story. What are we creating? What are we not creating? What is happening? Do we have usual context, unusual context? What are we overall doing, etc.? Again, this is currently, because this is very advanced, what I'm currently doing, this is basically applying all the knowledge that we're going to go over in the mentorship. But it's a great case study to make and to understand, to see what we might be doing as well. So again, we went over context right here. Now in the next video, we are going to go over candle signs. So candle signs, how that benefits us for context, for order flow, for fair value gaps, reading fair value gaps, what we can expect. For example, a previous X low sweep, previous X high sweep, etc. Everything that we can expect right there is going to be very, very interesting as well. All right, please feel free again to make case studies and fully understand what I meant with context, usual context and unusual context. Try to study it before we move on to the next video as well. All right, perfect. Thank you.